Welcome everyone to today's webinar using the best filters in Forex trading. Today, the Tuesday, 1st of April 2014, April's Fool's Day. For some of you, maybe you know that today is that day. Maybe you have an interesting joke that you pulled, or I don't know, someone did the opposite to you. If you do, let us know. Maybe we can have a laugh at the end of our session together. However, today is no laughing matter. This topic is actually very important for trading. Best filters in Forex trading. Filters are very important, and we'll discuss why in just a second. First of all, though, we're going to go through a bit of introduction. Once again, this is hosted by binary.com. My name is Chris, by the way, and we have to explain that there is risks involved in trading global financial markets and Forex. Not everyone may be suitable for trading and taking these risks. Please seek the advice of an independent financial advisor for more info. This webinar is for educational purposes only, and by continuing watching this webinar, you agree with the risk disclaimer and its content. Good. So thank you for your attention. Today's goal, we're going to be looking at filters in Forex and finding and using the best ones, or hopefully the best ones. As far as I know, these are the ones that are the best. So first of all, what is the role of filters? Then why use them at all? We'll be taking a look at what are quality filters and which ones are the best ones to use. So in FX trading, we have various filters. Okay, basically we have different elements. We have potentially time filters, we have fundamental filters, and we could call them technical filters. Maybe there are others as well, but this is the main three categories. What this basically means is we have three reasons not to take a trade. A filter, first of all, is something that means that we're not taking a trade despite the fact that our strategy says it is a setup, it is a trade at this point or that point. A filter basically means we're not taking that particular setup, we are literally filtering it out because of certain elements, like these three. What it means basically is picture yourself with, let's say, you know, some object, and you're looking for maybe a stone in sand. So if you pour the sand, right? If you pour the sand into something that distinguishes sand from rock, you're going to filter out the rock eventually, right? So you're filtering out something good. You're trying to get rid of the sand, and you keep over the rocks that you find interesting, for instance. Here too, we have a group of trades that qualify according to our strategy, and the filters are meant to basically keep the ones that are most interesting, the green ones, let's say. Okay, so what kind of elements can we use to filter out the less interesting trades? These three topics basically: time filters, fundamental filters, and technical filters. Time filters is basically knowing when and when not to trade. Fundamental filters are connected to news events and press conferences, roughly speaking, and technical filters are basically things that are on the charts, technical analysis. So let's start with explaining them a bit by bit, one by one. Fundamental filters are, for instance, NFP. NFP is non-farm payroll. It is the biggest news event in the month. It is basically explaining how many jobs have been created in the US, roughly speaking, and it is a very important guideline for the US economy and thereby also for the direction of the global economy in its sum aggregate. So very important level for the US dollar and all of the currency pairs that the dollar is of course used in. So when you have these news events, you're going to see a lot of volatility, you're going to see a lot of ups and downs, and a lot of quietness prior to that news event. So your normal trading, whatever you use, could be disturbed because of this quietness and volatility. All right? Unless you have a specific NFP strategy, you're going to have problems with that, or you could have. So it could be a reason to avoid trading certain strategies, or maybe at all. It could be a good day to go to the dentist or the barber, or it's one day in a month, so it could be a good day to do these organizational things, for instance. Other things, you want to watch out for upcoming news, high impact news events. Okay, those could rock the market. Now, depending, of course, on the strength of those, GDPs tend to be a bit more important than maybe, I don't know, let's say trade balance, for instance. Okay, I'm not saying trade balance is not important, but just there is a bit of a degree which one is more important than others. Now, usually news events are tagged actually as light, medium, or high. And within high impact, NFP and also FOMC are most impact or most volatile usually, plus the interest rate decisions of any particular currency pair, of course. Okay, for instance, Thursday we have a euro interest rate, as far as if I remember correctly. You also want to be careful with trading particular intraday levels and having a main red tagged event, even though maybe it's not that important. I mean, in a sense, like the pound dollar had a CPI today. I mean, it's not maybe a major, but it's the pound news event at 10:30 that is one that can rock the market and can move the market. You want to be careful with bank holidays because the market doesn't move. There's not much movement when banks are closed, or at least not doing that much. And most of the country of that country that we're looking at is not working, so we won't see that much movement. For instance, the US has a holiday, then the New York session might be very quiet. If Germany and UK have a holiday, then the London session might be very quiet. After 15 to 30 minutes, depending on the news event, things usually settle down. It could be even sooner. That depends on how hefty the price reaction is to the news event. So you want to be careful of that, and these could definitely be filters for not taking a trade when these things happen. Unless, of course, you are a news event trader. Well, then it's your prime time, and then you're waiting for these events. If you're trading with technical analysis, then you might want to use it as a filter, or any other analysis maybe. Time filters as well. Time filters are in certain degrees similar to fundamental filters, but in a sense that fundamentals are connected to a certain news event, but also press conference, such as the FOMC meeting, but also, for instance, the ECB president speaking. I didn't mention it here, but it's definitely worth adding that could be an important aspect. Also, for instance, the Fed chairman speaking. These are important speeches. And those speeches imply maybe future policy decisions and changes and confirmations. And those could definitely have their impact. So that too, not only really like hardcore direct numbers, but also press conferences. And those numbers are connected to forecasts. And if those forecasts and the actual levels, those relationships to each other have an influence. So for instance, if the NFP number is higher than expected, that's good for the US economy, and the dollar would strengthen in most cases. Time filters is a bit different because here we're looking at specific parts of the day and week and month. First of all, if you're in the GMT time zone, or let's say the Central European or even +2 GMT Moscow time zone maybe, then you want to avoid trading Asian session. Because you probably want to, you want to most of the time focus on the time zone that has the most natural, let's say, natural pattern in your life. You don't definitely want to trade 5 days a week throughout the day, 24 hours, 5 days, because you'll be just physically and mentally broken, right? So you need to find something that matches your rhythm and that is sustainable for you to be able to trade. Most of the time, trading the Asian session would mean trading during the night. Most people would not find that comfortable, so that would be a usual advice Of course, it also depends from person to person. Some people are night owls, so maybe you like that. However, if you do that, you would have to, I mean, it would be better to concentrate on pairs like the dollar yen, AUD USD, because those move a lot more than the euro dollar and pound dollar during the Asian session. Avoid basically trading during bank holidays. We talked about it already. No support and resistance levels are defended. You might want to think about being careful by the first day of the week and the last day of the week if you're trading intraday, because most movement happens and occurs on Tuesday, Wednesday, and Thursday in the market. The least, I think it's Friday. I'm not sure now which is the least, if it's Friday or Monday actually. But both are definitely less than Tuesday, Wednesday, Thursday. That's for sure. Usually Friday morning, New York time, Friday morning still has some movement. But as soon as you get closer to New York lunch, the last 5 hours of the market are pretty quiet. Same holds true for basically the start of the market. Things actually start off at 5 p.m. Sunday, New York Eastern time. Well, until London opens on Monday, you probably will not see that much movement. You'll see something, but it wouldn't be the most exciting period of the week. Now, if you're trading part-time, you might want to use a time filter, for instance, by trading 1 hour or higher. If you're trading full-time, maybe you would want to trade the most busiest period of the trading day, which is actually the London morning and the New York morning. Other things that I didn't mention here, if you're trading the last and first day of the month, those are always riskier. If you're trading the first week and last week of the year, or actually the first month and the last month of the year, anything that is first or last of anything, the first 5 minutes and the last 5 minutes probably, up to the last and first hour of the day, I wouldn't be surprised, is more riskier. Now, that last 5 minutes of the of the hourly candle is half a joke, but also half seriously in a way, because if you look at certain candle movements, they, funny enough, do tend to move quite a lot relatively. I think the first 5 minutes and the last 5 minutes, that has its own relationship there. But in any case, the first and last are always special regarding the time. And with regard to months, year, quarter ends, monthly starts, you want to be careful, because those always have a bit more difficult start. You want to see kind of like the market warm up a bit in a way. Picture someone going for a run, and what you want to do is, warm yourself up before you go for that, I don't know, 10-kilometer run. If you aren't warmed up, then it's, everything is a bit more rusty and a bit more difficult, right? That's the same with the market. The market has to warm up as well. So also when you start the day with intraday trading, the market just isn't loose as yet at the very beginning. So the movements aren't that fluid, and they're not going to move as much in one direction as you could have a bit maybe halfway today. All right, not at the end of the day, because then everything dies down again. All right, so optimal where the markets tend to start a bit more trending modes is probably 1 or 2 hours after Europe has started, up to the London close and New York lunchtime, roughly speaking. So those are all time filters and fundamental filters. Time actually, maybe just one more element on time actually, is also pretty useful just to understand at what point the trending mode could be finished. For instance, when London is closing and New York is going to lunch, you might want to, that's where your trade might want to be aimed at stopping. When you're placing your time limits on your trade, you might want to keep that in mind. How many hours do you want this trade open, right? You might want to close it at a point where the volatility ends, for instance. Depends on your strategy to strategy, but you can use time filter, let's say this time frame elements and time factor aspects to make decisions regarding your strategy and your plan. Now let's talk about technical filters. These are elements in the charts, and I guess most of you probably have been using some types of filters. These filters can include, for instance, support and resistance, key levels, patterns. It could be any tool for that matter, or any indicator. Trend lines, trend channels, Fibonacci, divergence, tops and bottoms. These all could be potentially filters. All right. Divergence, for instance, is when, or let's take a more, I'll talk about that later. Let's take a bit easier example. For instance, support and resistance. We have a daily top close by, a very important daily top. So in that case, and price is close to that level, would you be looking for a long if price is 5 pips away from there and it's just around the corner, literally? No, you would expect that level to be respected, especially if price is approaching that level for the first time. And that could be a very serious and very normal candidate to filter out that particular trade. It makes a lot of sense. And what we actually need to be making sure to, in a certain degree, is that we're not chasing the market. What we want to avoid is trying to take a trade just because we want to trade. We want to trade things that match our strategy, that make sense within the strategy that we've constructed. And filters is basically one of the steps that we are using to understand whether there's a good setup or not. I'll talk about that a bit more later on. But basically, these elements are something that we can think of when looking at filters. Now, other filter that we can use is the last one I mentioned. Reward does not match up to the risk. This is an important one. Let's say that price is at this green level and we have a daily high here. This is intraday trading, and a daily low, I don't know, somewhere, let's say here. Relatively close to the daily high, further away from the daily low. Taking a long at the green level and putting the stop loss at the daily low would mean that we have a risk of this red box. If we aim for the daily high, we have a reward, a potential reward of this green box. That green box is smaller than the red box, which means that we're risking more than our potential reward. And that negative balance, that negative correlation here, or actually not negative, but lower than 1, is most of the time not good. In most strategies, what you want to see is at least 1-to-1, if not more, depending on your strategy. But a usual trending strategy would have that 1-to-1 desire. Now, what would be a 1-to-1? 1-to-1 would be something where this is the reward, for instance, and the risk is smaller than that. It could be equal, the risk is equal, or it could be less, something about halfway. If it's halfway, then there's 2 times as much reward as risk. If the risk is maybe only this big, it's a third. If it's even less, it's a fourth of the reward. The bigger the relationship, right? The bigger the ratio between reward and risk, the better for us in a way, because we are gaining more when we win and we're losing less when we lose. Of course, this balance has to have some technical logic. It wouldn't make sense to take a very tight idea of what we're looking for. Let's say you're looking for a trade that you want to have in 5 minutes. That could be a very tight end of your trade, for instance. Or if you're using stop losses and you have a 3-pip stop loss, well, that doesn't make much sense, because the likelihood of that trade winning and gaining those 10 pips, even though you have a 3-to-1 reward to risk, for instance, is just not too much. Okay, even if you don't use stop losses because you're looking to exit at a time frame with binary.com, you still would like to take a look and see if there's space on the charts to know that the currency could move that. Even if you don't use those stop losses, you want to analyze the chart with that framework, with that mental idea and concept in your mind, so that you know whether the trade has enough space, basically. Okay? So we'll dive into these examples more later on. But this last one is very important. Here's an example where we have, for instance, the pound-dollar weekly chart. And we can see that price was at a major resistance level. There were tops here. There was a weekly trend line indicated by the black line. And when price approached that, it didn't push through that resistance immediately. Eventually it did, but only after it paused here for a significant time, made a bull flag chart pattern, and then broke to the upside. But the resistance was respected, and with respect I mean price stopped at that level and didn't break in one go. It first had to retrace, try again, failed, retraced, and then I think it broke, or maybe even again a retrace. Okay, same for these bottoms. Look at this. Here too. Support, 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 support. Finally, a break. So that's why it's very important to look at support and resistance and look at weekly and daily tops and bottoms, because those levels are major stopping spots, and you don't want to take a trade to the opposite side right in front of them. So that's why those are filters. I mean, if you're a reversal trader and you're trying to pick tops and bottoms, then obviously tops and bottoms wouldn't be a filter for you. So you can see the reverse psychology. In those cases, the tops and bottoms would be an opportunity. As soon as price gets close to them, you're actually close to a setup. You might not take the trade immediately. You might want to wait for confirmation, such as a price action signal at that level. But a filter for you, for instance, if you're a reversal trader, could be the absence of divergence, for instance, or the absence of a trend. If you're trading a range, the presence of a trend could be a filter for you. So it depends if you're with a trend trader, a range trader, or a reversal trader, what types of filters qualify for you. If you're a trend trader, then tops and bottoms and not going in front of them are important. If you're a trend trader, you want to maybe look for patterns, to look for continuation patterns. If you're a trend trader, you might want to use Fibonacci to know when the trend is going to continue. Okay, so that's how you have to look at it. I think we'll discuss that a bit later on more. Here, what is the role of filters? Basically, as I already said actually just now, we want to identify the current market structure. Is it trending? Is it a reversal going on? Is there a range? Depending what strategies we focus on, that's when we know whether the market structure and strategy are in sync. What I mean with that is basically that if you're looking for a trending market but the currency market isn't trending, well, the mismatch, right? So it's not interesting. If you're looking for a trend and the market is trending, well, then there's a match and we can move on and try to find an opportunity. That's point 2 here on this slide. Assess trading opportunities. Now with opportunity, there could be various things. The opportunity, for instance, for a reversal trader could be the fact that we have a major pin bar at a daily top. Well, that could definitely be an opportunity. Okay. Step 3 in this step-by-step module that I believe I wouldn't know why the trading plan would not have these steps is control. It's like a checklist prior to entering the market. Is control and check these filters. So that's how basically the filters are matched, are part of this trading plan. This, let's say, generic trading plan. Of course, then it depends on you how you make it and configure it to your own style, to your own strategies, to your own concepts and tools, etc. So once you have identified the current market structure, it's kind of like a potential setup, if you know what I mean. Potential setup. Once we have a trading opportunity, we have a trade setup. But a trade setup is not a trade because we still have to check the filters. And once we've checked the filters and there's no filter left, then we actually have a potential trade. Okay? So that's the difference. And once we have a potential trade, then we want to take a last look at triggers, and then eventually we'll have an actual trade. So that's basically the phase, the steps we traders want to take a look at before we actually trade. Now this is not something that everyone does. In fact, beginning traders usually just enter trade because price is moving, some action is happening, and usually are chasing the market. With chasing the market is exactly that. It's not planned. It just kind of like an emotional reaction or to price movement without really looking at the structure of the market, looking at what is their strategy saying, looking at what their technical analysis is saying, thinking about whether the market and everything is aligned with each other. Are you following your plan? Where's your stop loss if you use that, or where do you exit with the time frame at binary.com? So that all is not used and ignored. And well, no wonder, of course, that sometimes I guess you could be lucky, but in the long run or medium run or even short run, it's going to bump into problems. So that's why you want to have a sufficient analysis and preparation before trading, and filters is one of those steps. Is anything basically blocking the trade from materializing? Can anything stop and hinder this particular trade from hitting our potential target or from materializing and developing? Now obviously there's always could be one reason not to take the trade, and it depends on how tight you want to make these filters. Basically, you could have a strategy that is giving you maybe 10 signals a day, but you only want to have one trade a day. Well, then you can use quite a lot of filters because only 1 out of 10 is a trade. So, well, you have a lot of possibility to be quite strict with those filters. But let's say your strategy provides you 2 opportunities and you're looking to trade 2. Well, then maybe you actually have an incorrect strategy because to a certain degree your expectations do not match what the strategy can give you, in all honesty. So you want to have a balance. I mean, if your strategy is anything where it's very close to the number of opportunities you want, then you might want to rethink it. If you have a group of opportunities and you reduce those to, let's say, by a third or a half or less, then you have a good pool of opportunities that can be filtered out. Okay? If you have a pool and you're only reducing it by 10%, it's quite little. So maybe then it will be difficult to filter out and use those filters. Let's say you have, I don't know, 10 opportunities in a week, but you want to trade let's say 3 or 4. Well, that's fine. That's fine. Nothing wrong with that. In that case, you can be quite tight with your filters. Obviously, if you want to keep 6 to 7 of those opportunities, then you might want to be a bit looser with those filters. Now, trigger and entry methods are basically the next step after you've checked filters and no filters are blocking the trade, or maybe only one. As a rule of thumb, what I use personally is, find 3 reasons to take a trade, and max I want is one reason not to take the trade, preferably 0. Right? As just a quick rule of thumb. It depends from trader to trader. So if we have a green light for the first step and the second step, and no filters are blocking it, then we can move on to the fourth step, and which means trigger and entry. Trigger basically is when we have a setup when we say, okay, when price gets to the 50% fib, I'm interested, right? That's a trigger. If then you use a engulfing price action signal, let's say a candlestick pattern at the 50 fib, then that you can use the candlestick pattern as your entry method. Another example would be, for instance, the trigger could be a bounce off a trend line. Price moves down, hits the trend line, bounces. We don't enter, but it is our trigger. And as soon as price then makes this next hook back to a 50 fib, that could be our entry. So the difference is basically that the trigger is where we're interested in a particular currency pair or financial product, but the entry is actually where we enter. And the trigger, we can enter at the trigger, we can enter at the same spot as the trigger, but it doesn't have to be. Let's take the example of the 50 fib. Let's say you're looking for a 50 fib. If price gets to the 50 fib, you could enter right at the 50 fib, but you can also wait for a price action candlestick pattern. One is using the 50 fib as an entry, the other is using the 50% as a trigger. So why use them at all? Well, I hope that the usefulness is clear, and or at least is making some sense. If you still have some doubts, well, here are some reasons. Charts offer lots of info. We have a lot of ways to look at price and its movement and its potential movement. If we were to use all of that info, we would most likely bump into a problem called paralysis of analysis. And we would not be able to make any decisions and any judgments because there would be so much information and it could be conflicting information. It could be difficult. Now, depending on your experience, if you're very experienced traders, it'll be if you're an experienced trader, it could be easier for you to combine many aspects, many time frames, many elements to make up your mind and decipher when you think the market and the situation and price is the best for you to trade with the best reward to risk. That does take a lot of experience, and it's not something that is done overnight. It's not something that is created by looking at the charts for even a week or a month, logically. It takes time. You need a lot of experience. So by using filters, kind of more standard filters, you are making a checklist for yourself. And as I said, if you're very experienced, you will have kind of like a mental checklist probably, and you're more flexible in how you can approach, change your approach towards the market depending on how the market develops. If you're less experienced, especially if you're relatively a beginner, but even intermediate traders, you want to make it a bit more fixed. And in that regard, the charts could offer a lot of info, too much to handle, and that's why you want to actually, first of all, filter the info that you review and use for making trading decisions so that you have a trading plan that is actually executable. That means that you can actually implement. Because if your trading plan is too complicated, then it's going to be difficult to stick to your trading plan if it's that complicated. So you want a trading plan that is primarily doable, first of all, that is understandable and implementable. So in that regard, you're kind of filtering out price action using filters. And you're even kind of, ironically enough, you have to filter out how many filters you use, because if you use too many filters, that won't be too good either. So you need that balance as well, as I already talked about. What we then avoid is paralysis of analysis, information overload. What we can avoid by using filters is overtrading, chasing trades, getting emotionally disbalanced by trading too much, etc. Now, of course, if we use too many filters, we might be under trading, and we could get frustrated by that. And that, of course, is important that you make sure that you have a strategy that matches what you're looking for. Not only regarding winning and losing streaks, winning percentage and losing percentage, average wins and average losses, but also the number of trades one could take in a certain period of time. Now, other advantages is that it prevents us from overthinking and assuming. A trade might look good, but that is not really a qualification that should be part of our mental reference. We're not trading because something is looking good. We're trading it because we have reasons to take a trade or not. What I mean with that is we don't want to think what the price could do or where the price could go. It in a way really doesn't matter if the euro dollar is 141 by next week Tuesday. That's my opinion. It really doesn't matter for trading. For trading purposes only, it's about reward to risk, probabilities, and implementing that plan, making the plan, and then trading that plan. Right? It's about capitalizing on opportunities. And if we overthink that process, we are becoming our own enemies. What we actually are doing is kind of like looking at the technical analysis and Forex market, and we're looking at technical analysis as a roadmap to understand what price could do and what pieces are the most interesting to trade. What we're trying to do is react to price movements, not predict. So we want to react at the best times and the most profitable times possible, not try to be the fortune teller. Filters are specifically focused on analyzing why not to trade. The other elements are actually looking for reasons why we should trade. This has the opposite effect. This has the opposite role. And this has kind of like the critical hat thinking part of the process, right? The first two steps, we're looking for opportunity, and the matching market environment is actually like, okay, come on, market, tell me what part is interesting, where could I trade? And here is saying, okay, that was interesting, but let me twist the rules around here. How about if I look at it from a different point of view? Let me put my critical thinking cap on. What kind of things could be blocking this trade? That and that looks good, but how about if I look at it from this angle? So that's the role. So trading plan helps with filtering information to make it easier to digest price movement. Now, filters we can use on all time frames. As I said, you want to limit filters to avoid filtering out all setups, but in general, regarding the time frames, what I use as a rule of thumb, and this is just basically not specifically mentioning one time frame, because some trader could be using trader A could be using 1 hour, trader B could be using 4-hour charts. So what I do or want to show you here is the following. If you have whatever time frame you use to decipher the trend, go one time frame higher than that. So if you're using the 4-hour chart for your trend definition, then go to a daily chart or 8-hour, probably daily, and take a look if there's any substantial support or resistance close by. Is there any divergence close by? So that's something you could do. You could also go one time frame lower and see if there's any overextension on the lower time frame, so that maybe you could expect a pullback. And if you want to use filters on the same time frame, that could be maybe useful when you look at certain candlestick patterns. So I would not be looking for support or resistance on a lower time frame. Certainly not. That is of no value. I mean lower than the trend, to be precise. That would be the consequence of the info that I'm providing here. This is just a rule of thumb. Obviously, price action signals on a higher time frame could be interesting as well. If you had to look at one time frame, I would say look at one higher. That is the most important. And if you look at one lower, it's only like an additional benefit to see if you could see whether the trend or particular move is overextended or not. But it's more difficult to predict. It's more difficult to use, more difficult to analyze. So moving in one time frame lower than the trend is actually, I think, less important than going one time frame higher to see where the support and resistance are. So where I have the green box, that is by far the most important step in filters. Here's an example, finally, sorry about that, took a bit long, of dollar CAD daily. We have an uptrend channel on the dollar CAD daily, and you can see, of course, it all depends what type of trader you are. But if you're with the trend trader, you can see once price gets back to the bottoms here, that those are opportunities, in fact. However, if you're trading it for upside, however, if you're trading it a reversal trade and you're looking for downside, then the bottom of that channel is a filter to you. So I hope that reverse importance of the same tool is clear to everyone. If you have any questions, of course, let me know. I forgot to mention that, but by all means. So that's an example of the various rules one tool could have. Other things, let's take a look at, for instance, these tops in here. When we connect a line between these tops, we see price is making a higher high. When we connect a line between these tops, we can see price is making a lower high. What that means basically is price is not being backed by the oscillator, and that's called divergence. And when divergence is on the chart, the potential of price to continue with the trend is diminishing, and a retracement in this case, or even a reversal, which didn't happen in this particular pair, are increasing in probability. And just as a side note, mention or notice that I use the word probability because nothing is a guarantee in trading. Certain things do have a higher likelihood, and in some cases I might be very confident, but never ever is it really 100%. I mean, maybe in some cases I'm kind of like 99% sure, but in most cases you're not going to get close to that, to be honest. And that's just the market. The market is full of insecurity. That's just a fact of life. However, the fact that the market is insecure doesn't mean that our trading plan or the implementation of our trading plan has to be insecure. We could be very secure and very confident about how we approach the market. But don't be mistaken about mistaking that confidence about our plan and how we approach the market with being confident about what the market for sure will do. Those are two different things. Do I have a decent idea that this could be a bouncing spot? Sure. Is it 100%? No. But it's definitely at a support level. But it could bounce here or it could bounce here. That's an important difference. So it's about the details. And maybe, I don't know, let's say it's a 70% chance that I think they could bounce there. It's always difficult to say. Or even 80. It doesn't matter. But the point is that that 100% security is never there. But we can be secure and confident about how we tackle the market. Here's the pound odd. So let's see. Here we have an example of a trend line break of this magenta line. But what happens? Well, price breaks and doesn't go anywhere, or it doesn't go too far before it moves up again. And if you look at the time of day, it's basically end of New York session. It's almost closing the New York, and well, no wonder, right? Asian session hasn't started yet, so the Aussie not getting followed through. New York session is closing. The big players and actors are not part or participating that much. There's no push in the market. So this break doesn't go anywhere, and we get a retrace. Only at the Asian Open do we see follow through. Okay, that would be an example of a time filter here. Here we have the odd USD daily chart. Price obviously making a very nice down move and rebounding here to the upside, as we can see. So what happened? Well, we got a triangle indicated by the orange lines. We get a break of the triangle to the upside. And where does price stop? It stops at a confluence of the 50% Fibonacci retracement and a minus 272 target. And you can see price then starts to move away from that level. So here too, again, it depends on your vision. If you're looking for a turn at that 50 fib, then the 50 fib is an opportunity and the minus 272. If you're looking to trade it up to that level and you're seeing that as a target, where I have the green circle, then if the price is too close to that 50 fib, then you want to filter out any potential setups. If there's enough space to the 50 fib, then it could of course be a valid target. So let's talk about the reward to risk. If we know that 50 is a major daily fib, then that is a level that we have to be aware of. So depending on where we trade it, for instance, if we were traded on this at this green line, we can see a potential reward box of this. Now it depends how much our risk is. We need to find a good level that is technically safe. So we could look, for instance, and put it below a daily low and below the chart pattern and put the stop loss there if you use a stop loss. Otherwise, you have to use a number of hours that or days that makes the trade safe enough to take, right? Still, even though if you were to do that, it would be good to take a look what the risk versus reward would be if you would use a stop loss, just to get a feel if there's potential for that trade. And if you look at the blue box with the red box, what do we see? Well, we see that, I don't know, it seems to be like a 2.5 to 1. So that means that our reward potential is 2.5 times bigger than our risk. Is that more than 1 to 1? Yes, it is. Is that good? Yes, it is. We want more than 1 to 1. That's fine. So that's good. That's a good breakout trade. We have enough wide open space to the next resistance. How about if the opposite were true? How about if we take it here? What is our risk? Could be the same spot, doesn't have to be. But let's assume in this example that it is. That's our risk, this is our reward. How does that match up? Well, it looks like, visually, it looks like about 0.5 reward versus 1 risk. And that is not a good balance in most cases. So I'll put an X through that, and this deserves a smiley. So this is how you can match that up. Another example, Eurodollar daily. This is an example now of basically how price can keep pushing through resistance in some cases, but still, even though it pushes, look here, price does stop at this resistance level. It stops at this top, makes retracement, finds buyers at support, then moves up again. Stops at resistance, makes a chart pattern, then moves up again. This is the natural rhythm of the market. Trends, impulses, momentums, corrections, chart patterns, breakouts, trends, and all of these levels and movements are being stopped by support and resistance. It's the natural rhythm and heartbeat of price and of the market. Price doesn't know anything different than making these momentums and corrections. Let's see. Other than that, let me take a look if there's anything else to mention on this particular screen. Well, I guess, there are tons of examples that can be given on any screen shot, to be honest. But for instance, if we're looking for a trade to the downside, here's a bottom in play. So you don't want to go short right in front of that bottom with this much of a risk, and the bottom being the potential bouncing spot, and that blue box being the reward. That doesn't match up. It's about 0.2 versus 1. And we want 1-to-1 minimum. So no, this is absolutely not good. Okay. So one example of those steps I mentioned, for instance, we can look for a trend on the 4-hour chart. We can look, an opportunity could be a pullback within the trend. A trigger could be a trend line break. And a list of filters, maybe a bit too extensive, but could be fibs, daily and weekly tops and bottoms, divergence, etc. This is a bit on the high side, but I'm just giving you a wide spectrum of things that one could think of. So the success ratio of your overall system is measured by the most successful filter indicator. And what do I mean with that? For instance, if the AO, the awesome oscillator, is providing a better signal filter for a system than the RSI, then there's no need to use both. Okay, so no sense to make duplication here. That's the point, basically. Maybe it makes sense, but if one indicator, two indicators are roughly giving the same info, and actually they're overlapping each other, but one is a bit better actually than the other, then well, it's very simple to simplify the process and kick one of those indicators out. We don't want things on our chart that are not needed, not used, not providing extra benefits to the strategy. One of the best ones I find is the candlestick patterns at support and resistance. They're great stuff. Here's an example where we have, for instance, a pin bar right here, 2 pin bars in fact, right at the resistance. Lovely signals that provide basically great signals on higher time frames. If you don't have time to follow the market maybe within the day, then that is something that you definitely can think of. Price action, candlestick patterns at support and resistance. So examples of support and resistance, here they are. Tops and bottoms, highs and lows, fibs, trend lines, consolidation zones, chart patterns. These could all be filters. All support and resistances could be filters. So if you want to know more about support and resistance, I would refer you to the previous webinar. I think that was about support and resistance, if I remember correctly. So take a look at that video, okay? We will dive into that topic a bit more. Here are some examples of support and resistances, all these orange circles basically, indicating some levels of support and resistance. If you have any questions, by all means let me know. We got only 6 minutes left, so now would be the time. Other examples, manually drawn levels, pivot points, round numbers, reverse psychology, broken support becoming resistance in the future, broken resistance becoming support in the future. Fractals. Here too, we see pound dollar here, 1 hour chart, orange circles providing ideas when price is stopping or breaking and using support again, breaking and using support again, finding resistance. Other things, well, you probably could use all tools, Ichimoku. I use moving averages a lot, time factor, candlestick patterns, can angles. I mean, there are a lot of things you can use. Personally, what I use are these. I use Fibonacci, moving averages, time factor, fractals, tops and bottoms, trend lines. Those are my favorite, and I don't need those others. Basically, this is for me enough info, and I know the tools well enough to use them to my advantage. And that's, of course, another important step that is often underestimated. Maybe the tools are great, but you still need your own reference, your own experiences with these tools on how to use them. And that's something that only experience, of course, going to webinars like you do right now, reading, checking out, or talking to traders. It's all good stuff. I'm not saying it's great stuff. It's needed. It's part of the process. But we also need our own experiences with regard to looking at the market move and looking at price behavior. Here you can see the euro-dollar 4-hour chart, and we can see an example of price stopping at the 50 fib, the 61.8 fib, 78.6 fib. This is how I use Fibonacci to realize, where could be the stalling spots. And if price is getting close to these levels, then the reward to risk just isn't there. And you can see why, because price stops most of the time at these levels. For an intraday trader, an important top or bottom could be the daily high and lows. All these circles indicate basically how two highs and lows are, roughly speaking, very close to each other. Some cases you get a small break of the high or low. In other cases, they're roughly equal to each other. But you can see how, just looking at the daily candles, how many of these candles, mind you, it's very difficult to break the previous day high or low. So once again, if you have any questions, let me know. Otherwise, let me do a quick explanation of what we do on Monday mornings. So that's something that is it's 8 a.m., 7 a.m., excuse me, no, 8 a.m. UK time, 8 a.m. London time. Every Monday, we take a look at the charts and look at the price movement of last week and the potential price movement of this week. What are interesting levels? What are interesting trends going on? How's the euro dollar doing? What has the pound dollar candlestick price action done last week? So we look at the most interesting elements of a couple of currency pairs and analyze that to judge the most interesting potential of that week. It's a webinar that takes 20 to 30 minutes. It's looking live at current market events and not in retrospect like we did now. Not looking at theory, but looking at practice, real life, practical situations, not theoretical like we did now. Theoretical is great because we need to know that. We need to know what are the tools and concepts we can use, but then of course it's the implementation, and that's what we're doing in this live webinar. And if you want to register for this live webinar, you can do so at blog.binary.com/weeklytradingroom, and you'll get an email when the recording is ready, or of course you can watch live at 8 a.m. UK time. and we'll be done in 20-30 minutes. Or you can watch live and look at this recording. In any case, you'll get more info at this link, blog.binary.com/weekly trading room. So hope to see you next week, the 7th of April, as we take a look at our charts. Once again, live market commentary here at this link. Okay, so that wraps up the session for today. I guess if I don't see any questions soon, then we'll close it and stop for today. So that wraps up the webinar for today. Thank you so much for joining, and looking forward to see you next time. Next webinar, we'll be discussing chart patterns, I believe. So that's also very valuable info, and we'll be discussing how I trade those chart patterns as well. Wish you all a great week and great trading. Cheers, everyone.